Good afternoon and welcome to our inaugural podcast series that we have chosen to call the Invisible Heart Ventures podcast series. For those of you who don't know me, my name is Christian Kingombe. I'm the co-founding managing partner of 4P Group. I am myself an aspiring emerging impact fund manager and our company is domiciled here in the Canton de Vaud in Switzerland. And as an aspiring fund manager, I evidently hope to learn a lot from the peers who will be interviewed during this series. For the past 3.5 years, we have been running what we call our Impact Investor Circle webinar series, which covered 7 African countries: Zambia, Tanzania, Ghana, Nigeria, Kenya, Uganda, and lately South Africa. Our approach had been to spend a quarter in each country carrying out webinar during this time span, before we move on to the next target country. So the first country webinar was devoted to the overall impact investing ecosystem in the country that we covered, in collaboration with the local National Advisory Board for Impact Investing, the so-called NABs, or the task force if the NAB had not yet been officially established, as was the case in both Uganda as well as in Kenya at the time. The second country webinar focused on the role of the so-called market enablers in terms of creating a pipeline of investment-ready impact enterprises, which 4P Group endeavored to position as impact enterprises through our ESG toolkit training, including how to set up an impact measurement and management system for these enterprises, as well as for asset managers. The country round was then completed with our quarterly e-pitching event. As a new feature, we have earlier this year launched our Impact Lions 10 e-pitching event, whereby small growing businesses selected by our local partners, including the market enablers or the ecosystem support organizations such as accelerators, are being offered a platform to pitch their solutions to our pool of what we call our Impact Lions. These Impact Lions are usually impact fund managers investing in the global south with an appetite for impact tech solution contributing to the achievement of the Sustainable Development Goals and Agenda 2030. So, building on this existing Impact Investor Circle series, our new podcast will therefore discuss with the invited impact fund managers their activities, features, the profile of the general partners, with topic ranging from founder's background, the history behind the fund establishment, the governance structure of the fund, the composition of the general partners, the fund's targeted list of investors, including family offices, high net worth individuals, corporates, even multinational enterprises, or what their continued search for the limited partners look like. The fund's continued sourcing for investment opportunities across Africa with a focus of our 10 target countries. The importance of engaging and partnering with ecosystem support organizations, that is, as I said before, the incubators and the accelerators operating in our target countries, the role of the advisory committee members, the investment committee members, and whether subcommittees exist focusing on ESG issues, impact issues, or even what we call faith consistent investment issues. The financial modeling, whether they use their own models or how they test or check the models of the companies, their portfolio companies, and of course the ensuing negotiation process. We will also ask about issues related to the slide deck, the teaser, the fact sheet, the information memorandum, the term sheets, the investment policy statements, the investment guidelines, the governance processes with guides, oversight, to ensure that investments stay both SDG as well as faith value consistent. In other words, what are the fund's commitments to sustainability and the SDGs, and clearly stated faith values or ethical values. How did the general partner devise a targeted list of anchor investors, and what were the main selection criteria? The process of registering their fund in Luxembourg versus Mauritius, or even versus Switzerland, which is less common, and the advantages of choosing the reserved alternative investment fund. We'll also look at the process of drafting the deal documents with specialized service providers, including lawyers, in these financial fund hubs, and the actual signing of the deal, and what actually marks the fund's actual takeoff. We have previously in our Impact Investor Circle series organized 2 webinars addressing these issues at length, which you can find on our YouTube channel. The first webinar is called The Role of Non-DFIs in the Growth of Zambia's Impact Investing Market. And the other webinar is called The Deconstruction of the Deal Process and Impact Investing Climate in Zambia, featuring Goodwill Investment, Bongo Hive, and Good Nature Agro. So basically, we plan to discuss some of these operational fund issues faced by the general partners that we interview in our podcast. We also want to address the disconnect between growth in commitments, intentions, and labeled products, and the falling progress towards sustainability and the achievement of the SDGs. When it comes to the shift from claims to measured impact, data shows that 72% of companies mentioned the SDGs in their reporting, according to a report from PricewaterhouseCoopers called SDG Challenges. 25% of the companies included the SDGs in their published business strategy. Only 40% of the company mentioned specific SDG targets, of those 39% are setting qualitative ambition and 20% are setting quantitative ambitions. And only 1% are reporting quantitative measures to show their progress. Hence, the need to focus on internal management and decision making rather than just external reporting to explain this phenomenon and the disconnect. As you know, earlier this year I became an accredited SDG Impact Standard trainer, which means that I provide a certified training program for both company owners as well as asset managers, revolving around the so-called 12 SDG Impact private equity fund actions. These include number 1 within the strategy cohort or the strategy cluster. Number 1, understanding sustainability context and where material impact can be made. Number 2, develop fund impact and investment thesis. Number 3, set portfolio level impact goals. Number 4, adjust fund strategy and goals as needed to optimize impact. Then we move on to the management approach, which include number 5, align fund management systems and decision making with impact thesis and goals. Number 6, develop impact measurement and management framework. Number 7, select and structure investment in line with fund impact thesis and goals. And number 8, monitor and manage investment and fund level impact performance, acting to optimize and sustain impact, including after exit. And number 9, embed continuous improvement. And then we move on to the third cluster, which is transparency, which is step number 10, disclose how sustainability and the SDGs are integrated into the fund strategy and decision making, and report on performance. And then last but not least, when it comes to governance, we have step number 11, which is integrate sustainability and managing for impact into the governance framework. And number 12, ensure governing body leads by example. So, without blaming the general partners for this apparent disconnect, let's instead look at some of the main barriers, which was captured in a recent Swiss Sustainable Finance survey of the Swiss asset managers and asset owners. So, if you look at the asset managers investing in private markets, they highlight that some of the considerable barriers are the difficulties in implementing the investment process that reflect theory of change. They also highlight the challenge in gathering data on KPIs to report progress, as well as the overall risk, as well as the legal limitation to distribute to private clients. If you look at the asset owners investing in private markets, they highlight as the major barriers the overall risk, as well as the risk-return profile not matching investment strategy. They also highlight a couple of considerable barriers, such as required resources for due diligence, risk-return profile not matching investment strategy were also a barrier. What is needed to further scale investment with impact in Africa? For the private markets, transparency on achieved impact are considered very important. Other important factors include clearer definition of impact, internationally aligned standards, transparency on theory of change, education for institutional asset owners such as pension funds, as well as education for private clients. To what extent are the following approaches relevant to achieving investor impact? Again, from the same survey, when you look at private equity to impact, when you look at providing private equity to impact companies, you see that this is considered very relevant for 20% of the respondents to the survey. Only around 8% consider this relevant, and 1% consider this either as somewhat relevant or not relevant, respectively. When we look at providing private debt to impact companies, here around 18% consider this very relevant, 10% consider this relevant, and around 1% consider this somewhat relevant. Then when you take providing venture capital to impactful companies, again, this was considered very relevant by 17% of the respondents. Around 6% consider this either relevant or somewhat relevant, and just around 1% consider this not relevant. Then if you look at providing flexible or concessionary financing to impact companies, here almost 18% consider this relevant, whereas around 7% consider this very relevant, and then you had around 3% considering this somewhat relevant. How relevant are the following asset classes for achieving real-world impact in your opinion? Again, if you look specifically at private equity, here you find that over 20% consider this very relevant, around 7% relevant, and around, I would say, less than 1% somewhat relevant. Again, if you look at private debt, almost 18% consider this very relevant, 10% relevant, and around 1% somewhat relevant. So let's move on to identifying barriers for investing with impact. Again, what are the main barriers to achieving and communicating investor impact and or establishing and scaling funds in private market investment? Here, if you look specifically at challenges in defining meaningful KPIs, that is around 12% consider this as a minor barrier, a bit more than 5% consider this a considerable barrier, and less than 1% consider this a major barrier. If you take challenges in gathering data on KPIs to report progress, again, the majority, that's 10%, considered this as a considerable barrier. Around 8% consider this as a minor barrier, and around 3 to 4% consider this as a major barrier. When thinking about the difficulties in determining additionality, the major group was considered this as a minor barrier, was around 8% of the respondents, and then you had around 6% of the respondents consider this as a considerable barrier, and then you had around 6% did not consider this a barrier at all, and then you had less than 1% considering this as a major barrier. It's also interesting to look at the overall risk, including but not limited to currency. And here the major group was 10% which considered this a minor barrier, around 8% considered this a considerable barrier, and then you had around 2% which saw this as a major barrier. And then we can also look at the legal limitations to distribute to private clients. Here the major group, around 9%, saw this as a major barrier, around 7% saw this as a considerable barrier, and again you had around a little bit more than 5% consider this as a minor barrier. Okay, so again, looking at the private markets and the asset manager as a group, challenges in defining meaningful KPIs. This was really a minor barrier for more than 10%, a considerable barrier for around 6%, around 5% did not see this as a barrier, and then less than 1% saw this as a major barrier. Challenge in gathering data on KPIs to report progress. Again, the largest group was a considerable barrier with around 10% of the respondents, 7% saw this as a minor barrier, and around 4% as a major barrier. In terms of the difficulties in determining additionality, the largest group was major barrier, which was around 7%, 10% saw this as a considerable barrier, and around 4% saw this as a major barrier. In terms of the difficulties in determining additionality, the largest group saw this as a minor barrier, which is around 8%, and then you had a group of around 8% which saw this as a considerable barrier. Moving on to overall risk, again including but not limited to the currency risk, the largest group of respondents, 10% saw this as a minor barrier, 8% saw this as a considerable barrier, and then around 2 to 3% saw this as a major barrier. And last, in terms of the legal limitation to distribute to private clients, again, the major barrier was around, the major group that saw this as a major barrier was around 9%, and then you had around 7% which saw this as a considerable barrier, and 6% which saw this as a minor barrier. So let's move on to identifying solutions to scale investment with impact. So what is needed to further scale investment with impact in Africa? Well, here again you have a number of issues. Let me just look at those categories whereby very important was the major response from the respondents, and here you had a clear definition of impact, which was more than 10%. You also had education for institutional asset owners, which was around 15%. Then there's a tie. There was a tie between important and very important and important when it comes to education for private clients. So that this was the most salient categories when it comes to very important. You can also highlight again internationally aligned standards, which was considered important by more than 12%. Transparency on theory of change was considered important for 15%, and transparency on achieved impact was considered important for almost 20%. So, general partners, which will be interviewed in this podcast series, will be drawn from a pool of impact clients who have committed themselves to be an integral part of our impact Lions Den, and who in turn are sourced from the following universe of impact fund managers. So who are those impact fund managers? Basically, more than 250 plus investment firm has been identified across or investing across the African continent. You have four categories. You have the venture capital funds, you have the family offices, you have the privates, and you have other funds. And then you have the direct corporate investment, or CVCs. You also have government or development finance institutions. And then lastly, you have foundations, philanthropy, and even NGOs. If we look closer at the Africa's funding landscape with a specific focus on the 10 countries that we're looking at in overall, and which has been covered by our Impact Investor Circle series, if we start by Ghana, in Ghana you have around 9 venture capital funds, whereas in Nigeria, which is the biggest economy in Africa, you have 30 venture capital funds such as Spark, Altia, Quantum, LeadPath, Growth, Neon, to mention but a few. South Africa, the most sophisticated and industrially advanced economy in Africa, it has around 55 venture capital funds. Some well-known names are Naspers, Digami, you have CBP, RRC, Newtown, Uprise Africa, Ocean, IDF, and so on. Then we can highlight Congo DRC, which is very new to the venture capital industry. You have a company like Sycomore Ventures or TaxFs. Then you have Zambia, where we have our local office, Impactpreneur Africa Limited, where Forward Griff is a majority shareholder. Here you have Kukula Capital and Senga. So a handful of venture capital funds. Then you have Egypt, which has 70 venture capital funds. You have Ethiopia, which is also fairly new to the venture capital industry, where you have 2 venture capital funds, including Novostar Ventures. Then you have Uganda with a handful of venture capital funds, including Finca, Ulengo. Then you have Kenya, which is one of Africa's big venture capital hubs with 26 venture capital funds, including Novostar. You have Factor, Akili, Afritech. You have Saka Ventures, Wilgrow, Insa Capital, and so on. You also have Tanzania, which is fairly new to the venture capital industry, where you have less than a handful of venture capital funds, including Sahara Ventures. You have Mauritius, which of course is a big financial hub in Africa, where you have also a handful of venture capital funds, including Leapfrog. So this is basically what the landscape looks like, from which we are drawing our impact lines. So from this universe, we have selected around 25 lions and lionesses, our so-called impact venture capital funds, including Emerging Africa Group in Nigeria, Beyond Capital Ventures operating from Kenya and South Africa, Launch Africa Ventures, which is really one of the pioneers when it comes to impact, when it comes to the venture capital industry in Africa, operating out of Cape Town in South Africa. You have Darena Ventures, which is domiciled in, operating out of Zimbabwe. And then you have Enco Capital, which is mainly operating out of West Africa. So with these general partners, we will additionally discuss issues focusing on the fundraising success factors, including A+ leadership, passionate founders, large, fast-growing, underserved markets, leveraging network effects, building authoritative, trusted brands, obsessed on customer experience, reasonable financing, the sense of urgency, missionaries, not mercenaries, commitment to technical and market excellence, doing well by doing good by adopting our SDG Impact Standards for our asset managers. The Lions will also be interviewed about the fundraising plan for company owners, a topic we will go through at length in the second part of today's podcast by looking at some of Carter's newly released data. So see you in the second part of the podcast, which you can of course can watch in the subsequent video, which will be uploaded on 4P Group's YouTube channel.